Everyone. All right, friends. So today we will be completing the other rest of the provision. So without wasting time, let's start with the capital gains. Okay, we have certain pending items under capital gains. So let's finish off all the pending items under capital gains. So good morning, everyone. Good morning. Good morning. Yeah, I'll mute everybody, don't worry. Yes, I have muted. Good morning, good morning. Yeah. So friends, yesterday we have completed some part of the capital gain, right? It was not in an order. Today and we will follow the order and we will complete the rest of the capital gains. So the first thing that we have to discuss today is section 45 subsection 2, that is conversion or treatment of capital asset as stock in trade. So we are about to discuss a concept called as we are about to convert capital asset into what? Stock in trade. What do you mean by converting capital asset into stock in trade? What do you mean by converting capital asset into stock in trade? Very simple. Say, I'm an AC trader. Okay, we'll stick on to the AC itself. I'm an AC trader. I have installed an AC in my office. Okay, I have installed an AC in my office. So I'll make use of an example. Say, for example, I am an AC trader. I purchased an AC. I purchased an AC for 1 lakh rupees. In 2021-22. Okay. In 2021-22, I purchased an AC in 1 lakh rupees. Then I converted that particular AC into what? Into my, it was purchased in 2021-21 and installed an office. Okay. Installed an office. It was installed an office. Then what I did is like, yeah. So thereafter, I converted that into my stock in trade. I converted that into my stock in trade in 2022-23. I converted that particular AC into my what? Stock in trade in which year? 22-23. At the time of conversion, the fair market value of the AC was say 1,50,000. At the time of conversion, the fair market value of the AC was how much? 1,50,000. Thereafter, in 2023-24, I sold that particular stock in trade. I sold that particular stock in trade and say the sales value. The sales happened at 1,80,000. Alright. So for the time being, forget about the depreciation of that particular AC. Okay. Forget about that particular depreciation of the AC. So you tell me what all other things happened. I purchased an AC in the year 21-22. Then I converted that particular AC. I purchased and installed it in my office. So it is basically my capital asset. So I converted that particular AC. That means I dismantled that particular AC and packed it again. And that packing happened, or I put it as my stock in 22-23. Then I sold that particular stock in 23-24. So there are certain series of events happened in this particular example. So whenever there is a conversion of capital asset, whenever there is a conversion of capital asset into stock in trade, that is regarded as transfer for the purpose of capital gains. This is regarded as what, friends? Transfer for the purpose of capital gains. If it is a transfer, then you have to compute the capital gain because there is a capital asset Conversion is regarded as a transfer. So you must compute the capital gain over there. Are you all with me? So how do you compute the capital gain? You need to take the full value consideration as the fair market value as on date of conversion. You need to take the full value consideration because you are not getting anything. When you are converting that capital as into stock in trade, actually you are not getting anything. But because departments say it is a transfer, you need to compute the capital gain. And how do you compute the capital gain? Very simple. On the date of conversion, how much ever is the fair market value of that particular stock in trade, you take that as the full value consideration. So 1,50,000 will be the full value consideration. How about the cost of acquisition? The cost of acquisition will be the original purchase price of say rupees 1 lakh. Forget about the depreciation effect of that particular AC. And you tell me how much will be my capital gain? My capital gain will be 50,000. Now listen, moving on, it's not yet over. Then I sold that particular AC for what? For 1,80,000. So when I sell this particular AC, that will come under PGBP. Yes or no? Yes or no? What is the sales value? 1,80,000. Now for the purpose of PGBP, how much should be my cost? I need to take that fair market value as the cost now. For computing the profit under PGBP, I need to take the fair market value as my cost. And how much is the fair market value? 1,50,000. Now, can you tell me how much is the profit under PGBP? How much is the profit under PGBP? 30,000 is the profit under PGBP. So, listen, overall, I purchased this AC for 1 lakh and sold for 1,80,000. This is what is the complete effect of that particular transaction. So the total profit of 80,000 have to be split among capital gain and PGBP. The total profit of how much? 80,000 have to be split among both the capital gain and PGBP. And the interesting fact is both this 50,000 and this 30,000, that means both the capital gain and PGBP have to be taxed in the year 2023-24. You have to tax both the capital gain and PGBP in which year? 2023-24. That means in the year in which you sell that particular stock in trade, you have to compute both the capital gain as well as PGBP. Is that point clear? Is that point clear? Yes. Normally, you have to compute the capital gain in the year of transfer. Okay, you have to compute the capital gain in the year of transfer. But the point here, what they're saying is, here you need to compute the capital gain as well as the PGBP both in the year in which you sell that particular stock. Whenever you sell that particular stock to an outside person, on that day only you are supposed to compute the capital gain as well as PGBP. Is that point clear? Is that all clear? Moving on to the theory part of it. Let's see what exactly is the theory. So can you read this? Gain from such transfer shall be taxable in the year in which such stock in trade is sold by him. So whenever you sell that particular stock in trade, in that period only you are supposed to compute the capital gain. And let's see on conversion. How much will be taxable under capital gain? Fair market value as on date of conversion minus actual cost of acquisition will be taxable under capital gain. And how about the business income? Sales price minus fair market value shall be the business income. And how about the indexation effect? Indexation benefit available till the year of conversion. In this asset which we were discussing, there is no indexation. Why? Because period of holding is around 1 year only. So normally if it is a long-term capital asset and converting it into stock in trade, are you eligible for indexation? Yes, but only till the date of or year of conversion. I hope it is clear. Are you all with me? Are you all with me? So you can claim that particular indexation only till the year in which you sell that particular, you convert that particular capital asset into stock in trade. That's what they are saying. Now there is one more note. What is that note? Can you read that note? Both the capital gain and PGBP is taxed in the year in which such converted stock in trade is actually sold. So both the capital gain and PGBP both are getting taxed in the year in which you are selling that particular stock in trade. That's what they are saying. I hope that point is clear. In this case, why we did not doing indexation? Because only 1 year period of holding. FMV will be on the year in which we sell the stock in trade. No, conversion. Okay. See, FMV as on date of conversion is 1,50,000. So you have to take that particular FMV only. FMV will be on the year in which sell the stock in trade. No, it's on the point of conversion. Okay. I hope it is clear. Now, moving on with the next concepts, that is 45 subsection 2. That's what we have discussed right now. And moving on to the next point, that is section 45 subsection 5. Can you read what is 45 subsection 5? Compensation on compulsory acquisition. So tell me, friends, what do you mean by compulsory acquisition? What do you mean by compulsory acquisition? What is compulsory acquisition? Very simple. Say, for example, you have a property, okay? You have a property. That property is taken over by the government. The property is what? Taken over by the government, either central government or state government, for a development of either road or any bridge or something like that. Okay, so the property is taken over by the central government or state government for the purpose of development of anything like a bridge, road, railway station, airport, whatever it is. So whenever they are acquiring your property, like a land or a building, they will definitely give compensation to the owner. Are you all listening? Whenever the government takes over a particular property, they will definitely provide compensation to the landowner or the building owner. That compensation have to be assessed under capital gain. Why? Because compulsory acquisition is also regarded as a transfer. Are you with me? Are you with me? Say I have a land and the government came and compulsorily acquired by particular land, and they will pay me a compensation, and that compensation paid by the government to me is definitely subjected to capital gain, and that's what we are about to compute. Now you tell me, what will be the full value consideration here? What will be the full value consideration in compulsory acquisition? The compensation received by the government will be the full value consideration. So total compensation or consideration received or receivable shall be the full value consideration over here. And how about the cost of acquisition? Actual purchase price. The cost of acquisition does not have any speciality because it is your actual purchase price only. Now, how about the expenditure on transfer? The legal expenditure incurred to recover the claim shall be allowed as deduction. In compulsory acquisition, there won't be any brokerage and all, because government is directly coming in acquiring your asset. Yes or no? But there can be legal charges for your negotiations and other things. There can be legal charges that you are incurring, and that legal charges you can definitely deduct as what? Definitely deduct as what? You can definitely deduct as what? Expenditure on transfer. And when is the chargeability? In the year when such compensation or consideration or part thereof is first received. Listen. Say today I had a property and government compulsorily acquired my property today. Only after 4 years I received what? Compensation. Only after 4 years I received what? Compensation. You tell me, do I have to pay taxes today or after 4 years? After 4 years only. Why? Because department say, even though the transfer is compulsory acquisition, you need not compute any capital gain and you need not pay any taxes, because we know that it will take some time. Yes or no? Because it's a governmental matter, they have to follow the procedure. So government say, don't worry, we have no plans to tax you in the year of compulsory acquisition. Rather, you pay the taxes in the year in which you receive the compensation from the government. You need to pay the taxes in the year in which you receive the compensation. That's what the department says. Now, moving on to the next one. How about the indexation? You will receive the indexation till the year of compulsory acquisition only, not till the year of receipt of compensation. If the asset is a long-term capital asset, you can claim the benefit of indexation, but only till the year of compulsory acquisition, not after that. I hope it is clear. Moving on to the next one, there is a thing called enhanced compensation. What do you mean by enhanced compensation? I've received, say I had a property, okay. I had a property, government compulsorily took over my property. I said the compensation paid by them, and they paid me 1 crore rupees as compensation. They paid me what? 1 crore rupees as compensation. I filed a case stating that 1 crore rupee compensation is very less. I filed a case stating that 1 CR compensation is very less. And there was a court hearing, and during the end of hearing, I received another 50 lakhs. I received what? Another 50 lakhs. Or the court judgment told the state government to pay an additional 50 lakhs. That additional 50 lakhs that I received as a part of the litigation is said to be what? Enhanced compensation. That means the original compensation means the compensation voluntarily given by the government. Enhanced compensation means you filed a case or something, and after that arbitration or case, you are receiving something more. And that something more is said to be what, friends? Enhanced compensation. Are you with me? Are you with me? So let's understand enhanced compensation chargeable in the year in which the same is received from the government. Whenever you receive that enhanced compensation, in that year, you need to pay the taxes. Are you all with me? In the case of an enhanced compensation, whenever you receive an enhanced compensation, you need to pay income tax in the year of receipt of enhanced compensation. That's it. Now, while computing enhanced compensation, you tell me whether the enhanced compensation is a long-term capital gain or short-term capital gain. For that, you need to check whether the original compensation is long-term or short-term. Enhanced compensation is only a continuation of the original compensation. So what the Act says, if the original compensation is long-term, enhanced also will be long-term. If the original is short-term, enhanced also will be short-term. Are you with me? Because enhanced compensation is another episode of original compensation. You will get that later, that's it. Okay, so what they are saying is, as in the case of initial compensation or consideration. So the nature of gain on enhanced compensation, whether it is short or long, depends upon the nature of original compensation. If original is long, enhanced also will be long. Now, along with the enhanced compensation, definitely there will be some period of time required for you to receive the enhanced compensation. Why? Because the hearing or the arbitration have to get over. Yes or no? Are you all listening? See, you will receive enhanced compensation only at the end of court hearing. So there will be some time taken in receiving the enhanced compensation. So normally the enhanced compensation will be awarded along with interest. Normally the enhanced compensation is awarded along with the interest, and that interest will be taxable under IFOS, not under capital gain. Are you with me? So interest on enhanced compensation, if any, always shall be taxable under IFOS. And there is one interesting thing. Under IFOS, you can claim a standard deduction on this interest at 50%. That means, say, you're receiving 10 lakh rupees as interest, you need to pay tax only for 5 lakh. Why? Because you can claim a standard deduction for this interest. And how much is the standard deduction? 50% of interest received shall be the standard deduction. Are you all with me? Is that point clear? Is that point clear? So this is how you have to compute the effect of enhanced compensation in Income Tax Act. So these are the two other theories which were pending yesterday. So we have completed that. And mode of computation of capital gain, indexation, etc. we have already done. And there is one point that you have to be careful. While computing capital gain in respect of a listed share or security, while computing capital gain in respect of a listed share or security, STT paid shall never be allowed as a deduction while computing the capital gain. What is STT? Security Transaction Tax. Say I have purchased some listed shares. Thereafter some period of time I sold that particular listed shares. Now the question is, can I claim the STT that I paid at the time of purchase and sale as a deduction? The answer is never. Never. While computing capital gain, you are not supposed to include STT paid as a deduction. Are you all with me? Ali Nivas, because today we have an agenda. We have to finish off the other things. So I have no plans to give you a question in compulsory acquisition. Okay. So you have to adjust because today we have an agenda. We have to finish this IFOS and we have 115 BAC. Okay. Which are more important than this. So let's stick on to the agenda. If that gets over, definitely I can throw you some questions on that. Okay. Yes. Why STT is not deducted? Because that you have to ask to the central government. Okay. It's a rule. They are saying you cannot claim security transaction paid as a deduction. That's it. Yes. So moving on to the next point, index table and all we have already computed. Now there is a note under this. Can you read this note? cost of acquisition or cost of improvement shall not include any expenditure or a deduction which is already claimed by the assessee either under section 24B or under chapter 6A. Say for example, imagine a case. Say I purchased the house. I purchased the house by taking a loan. By taking what? A loan. The interest that I'm paying, say it is a self-occupied property, okay? Say it is a self-occupied property and the cost of the house was say 10 crore. Okay, I will bring it down. 50 lakhs. The cost of the house was how much? 50 lakh. The interest that I paid is 10 lakh. The interest that I paid is how much? 10 lakh. But for this interest, you can claim a deduction under 24B, house property. Whether it is self-occupied, whether it is let out, whatever it is, whether it is deemed let out, the interest that you are paying is allowed as a deduction under 24B. Now the question is, say I am selling this house property. I am selling this house property for 80 lakhs. How much is my cost of acquisition? Is it 50 or is it 60? It is only 50. You cannot claim 60. Why? Because that 10 you have already claimed as a reduction under 24B. That's what this note is all about. While computing the cost of acquisition or cost of improvement, it shall not include any expenditure or reduction which is already claimed by the assessee under section 24B or under chapter 6A. Are you with me? Are you with me? So whenever you are computing cost of acquisition, you are not supposed to consider what? All the deductions that you have claimed under 24B or chapter 6A deduction. I hope it is clear. Say 50 lakh is the cost of the asset. 10 lakh is the interest that I paid. That interest I have already claimed as a deduction under 24B. Now I have sold this asset for 80 lakh. Now the question is, can I claim this entire 60 as cost of acquisition? The answer is no. I cannot claim this 10. Why? Because it is already deducted under 24B. Okay. Yes. PGBP 36 is different. Okay. That is for PGBP. Okay. Yeah. STT is same. There is only one STT. If you are a full-time trader, you can claim the STT paid as a reduction under 36. If you are an investor and all, like doing this trading as a capital gain activity, then you cannot claim this STT paid as a deduction. That was the point is. Government acquired my land, government paid 10 lakhs as compensation. After 2 years, I got 3 lakhs as enhanced compensation. For enhanced compensation, cost of acquisition will be 0 Aliniverse. Why? Because while at the time of receipt of original compensation itself, you might have claimed all the cost of acquisition. Okay. So for the enhanced compensation, cost of acquisition shall be 0. Got it? Is interest which has not allowed as deduction partly can be included in the cost of acquisition? Yes. Interest, if it is not allowed as a reduction, then you can consider that as a cost of acquisition. Yes. Yes, Shashi, it's possible. Now, moving on to the next point, we were discussing about indexation and the other thing. We have computed already. We have finished how to compute long-term capital gain, how to compute short-term capital gain, indexation and all. We have already completed yesterday. Now, let's move on with the other things here. What are the other things? Section 49, ascertainment of cost of acquisition in certain specified circumstances. Can you read that point number 1? We were about to determine the cost of acquisition special circumstances, and let's understand each cost of acquisition point one by one. So I want all of you to be very attentive right now. So listen friends, what do you mean by determination of cost of acquisition in certain special circumstance? What do you mean by determination of cost of acquisition in certain special circumstance? Very simple. In certain circumstance, while determining the cost of acquisition, you have to follow the things which we are about to discuss right now. Are you with me? In certain circumstances, when you compute cost of acquisition, you have to mandatorily follow the things which we are about to discuss. And let's understand which all are the circumstances. Okay, let's understand which all are the circumstances. So can you read that point number 1? In the following cases, cost of acquisition to the previous owner deemed as cost of acquisition of asset, where the capital asset become the property of the assessee on total or partial partition of HUF or under a gift or a will. I have only selected important items under this. Okay, we have a lot more items under this, but I have only selected 2 important things under this. What does that mean? Very simple. I'll create an example so that you will get a better idea on what exactly is that particular point. Listen, say for example, say father, Mr. Father purchased an asset in say 2010-2011 for 10 lakhs. For what value? 10 lakhs. He transferred this property in the name of his son. We can say Mr. Son. He transferred or gifted, we can say gifted. He gifted this particular property in the name of Mr. Son, and this gift happened in the year 2016-2017. Mr. Son got this particular asset, or we will take a later date. Say 2021-22, Mr. Son got that particular asset. It is a gift from his father. Then what Mr. Son did? Mr. Son sold that particular asset. Okay, Mr. Son sold that particular asset in 2023-2024 for a value of 50 lakhs. Sales value was how much? 50 lakhs. While computing capital gain, which all are the things that you have to be careful. Let's see. Say, who is the transferor in this example? Son. Son is the transferor. So, for son, how much will be the full value consideration? 50 lakhs. For son, full value consideration will be what? 50 lakhs. For son, what is his cost of acquisition when he sells that asset outside? For son, what will be his cost of acquisition when he sells that particular asset outside? You tell me. What department? Say in such scenario, you can take the cost of acquisition of your previous owner. So while taking cost of acquisition, previous owner's cost you can take as your cost of acquisition. That means father's cost you can take as cost of acquisition. Now the next thing, while computing period of holding, you can take the date of purchase of asset by the father till the date of sale by the son. So period of holding will be from 2010-11 to 2023-24. While computing period of holding, date of purchase of asset from by the father till the date of sale by the son you can take. The next thing, how about indexation? There's a problem. Indexation, Income Tax Act is actually silent. Okay, about indexation, Income Tax Act is silent. So in that case, there is a thing called Manjula J. Shah. Manjula J. Shah is a case which is cited by the Bombay High Court. It is a case, name of a case, Manjula J. Shah, cited by the Bombay High Court. And what Bombay High Court says in this particular case is very simple. While computing indexation also, you can take indexation from 2010-11 to 2023-24. You can take indexation from 2010-11 to 2023-24. Are you with me? Are you with me? So whenever there is a gift from father to son, and son is selling that particular asset outside, then what you need to do is, you need to what? The cost of acquisition of the previous owner shall be the cost of the transferor. The period of holding also starts from the date of purchase of the asset by the previous owner till the date of sale. And while computing indexation also, you can take the previous owner's date till the sale by the transferor by quoting this case law called as Manjula J. Shah. You don't have to write Bombay High Court and all, but you have to write the case name. That will be better. Are you with me? So you tell me, while computing this, how much will be the indexed cost of acquisition? Can you help me with the index numbers from the revision note? Into 348 divided by 167. And how much will be the indexed cost of acquisition? 20 lakh 80,000. 8,383. 83,832. And tell me how much will be the taxable long-term capital gain? 29 lakh 16,168 will be the long-term capital gain taxable. I hope it is clear for you. Are you all with me? So, and one more thing, this gift by the father to son is not a transfer, okay? Not a transfer according to the income tax law. This is not regarded as a transfer. Yes. What if son paid nominal amount? Then it is not a gift. It's a proper purchase. Okay. Yes. Now moving on with the next item, and there is one more thing, total or partial partition of HUF. What do you mean by total or partial partition? Instead of father, say an HUF bought an asset. Okay. One of the members of an HUF told that I'm not interested in doing joint business. I want my share, I'm going out. That HUF given that particular asset to the outgoing member. Okay, the HUF given that particular asset to that member who is willing to go out from the family. So the circumstance is same. Instead of father, it will be HUF. Instead of son, it is the going member. Then the rest is same. The going member after some years is selling that asset. The cost of acquisition will be the cost of acquisition of HUF. And the period of holding have to be started from the date of purchase of asset by the HUF till the date of sale by the member. Indexation also from the date of purchase of HUF till the date of sale by the outgoing member by quoting Manjula J. Shah. I have given these as notes. In the above circumstances, period of holding of the transferee, period of holding of the asset by the previous owner shall be considered, and benefit of indexation in the above circumstances can be claimed from the date of holding of the asset by the previous owner till the date of transfer. That is Manjula J. Shah. BOM means Bombay High Court. Are you with me? Are you with me? Great. Now, point number two that you will understand under when we discuss IFOS. Okay. Whenever a gift is taxable in the hands of, recipient, one second. Yeah. So whenever there is a transfer and that transfer is taxable in the hands of a recipient, then you have to make use of that taxable value as the cost of acquisition on its subsequent transfer. This you will understand after completing IFOS, taxation of gift. Taxation of gift is there. That is the next thing that we are about to discuss soon after finishing capital gains. Okay. Taxation of gift. After completing that, you will understand what exactly is this note. Now, cost of acquisition of different assets, yes. Let's understand the next cost of acquisition. Right shares we have already completed last day, okay. So, next is goodwill of a business or a profession. How about goodwill of a business or a profession? What is the cost of acquisition? In the case of a self-generated goodwill, and I'm selling that particular goodwill outside, what will be the cost of acquisition? You tell me what will be the cost of acquisition? 0. Why? What is self-generated goodwill? I'm doing good business. Automatically, I have a brand name. That brand name I got without any extra money. I have to do good business. I'll automatically get that particular brand value. Are you with me? It is right that you have to do advertising and all for getting a good brand name, but that is only for your sales. That advertising you have already claimed as your business expenditure. So, to generate goodwill, department say, if self-generated goodwill, the cost of acquisition shall be always 0, nil. How about purchased goodwill? Say I purchased this KS Academy, this brand name, okay, by paying 10 crore rupees. Okay, now after 4-5 years, I'm selling this for 15 crore rupees. Now, if I'm purchasing the goodwill, then the cost of acquisition will be what? Cost of acquisition will be what? The original purchase price. That's it. Then the cost of acquisition will be the original purchase price, and this is what we can say. Are you all with me? So this is what we can say in the case of a purchased goodwill and self-generated goodwill. So in the case of purchase, cost of acquisition of the purchase price. In case of self-generated assets, cost of acquisition shall be nil. And for goodwill of a business or a profession, the cost of improvement shall be always 0. Why cost of improvement is always 0? You don't have to incur anything for what do you say? For increasing the value, okay? For increasing the value or for generating more goodwill, you don't have to incur any extra cost. You do good business. So the cost of improvement of goodwill shall be always 0. Yes. Bonus shares we have already completed. Then do you remember what if you have to do if you are purchasing an asset on or before 1st April 2001? Then the fair market value as on 1st April 2001, that also we have already done. Now, there are certain things while computing the long-term capital gain under section 112A. That's what we are about to discuss. So, before discussing that, let me jump into the rate of taxes. Okay, let me jump into the rate of taxes. We will discuss the rate of taxes that are applicable in the chapter capital gain, and we'll finish this and we'll come back to the 112A cost of acquisition special scenario. Are you all listening? Are you all listening? So this rate chart will actually help you in understanding what are the rates and what are the other conditions in regard relating to the particular rate of taxes in capital gain. So we can call this as a rate chart. We can call this as what, friends? A rate chart in capital gain. So moving on to the first item, how many types of rates we have in capital gains? We can say 3 flat rates and 1 common rate. 3 flat rates means long-term capital gain under 112 is there. Long-term capital gain under 112 is there. Short-term capital gain under 111 is there. And normal short-term capital gain is there. We can split that into 4 normally. So we'll start with the short-term capital gain under 111A. Are you all listening? So you tell me, what is the short-term capital gain under 111A? Short-term capital gain on transfer of listed equity share of a company where STT is paid at the time of purchase and transfer. What do you mean by listed equity share where STT is paid at the time of purchase and transfer? Very simple. You purchase some listed shares. You hold it for some period and you're selling that particular listed share. And the period of holding is how much? 12 months or less. Then the gain that you're getting will be a short-term capital gain, and that shall be taxable under 111A. And what will be the rate of tax? Flat rate 15%. Do you remember? I have given you an outline on how to apply the rate of taxes, a thumb rule. If for a particular income, rate have been specifically mentioned in the IT Act, you have to apply that rate. If a specific rate is not in there in the IT Act, then you have to apply the slab rate. Do you remember this? Do you remember this? So this is actually something related to that 111A. What they are saying is, if you have a short-term capital gain on transfer of a listed equity share or a listed unit of equity-oriented fund or a listed unit of a business trust. So you have 3 assets. If you have what? Short-term capital gain on listed equity share or unit of equity-oriented fund. What is this unit of equity-oriented fund? Majority of investments of a mutual fund, if it is in equity, then we can call that particular mutual fund as an equity-oriented fund. If majority of investment is in debt, then we can call that mutual fund as debt-oriented funds. If it is mix, that means 50-50 mix and all, we normally call it as hybrid funds or hybrid mutual funds. Are you with me? Are you with me? So a mutual fund that predominantly focuses on equity is said to be equity-oriented fund. And if you have invested in that equity-oriented fund, you will be called as a unit holder of that equity-oriented fund. And you are that equity-oriented funds unit holder and selling that particular units, and you are having a short-term capital gain, that will be subjected to what rate, friends? 15% rate of tax under section 111A. Are you with me? Or a unit of business trust where STT is paid at the time of transfer. Business trust means REIT, Real Estate Investment Trust and Infrastructure Investment Trust in India. 2 things are normally considered as business trust in India, REIT and InvIT. Similar to mutual fund, REIT, how does it work is like you can invest in REIT. REIT will make use of your investment to generate profit from real estate. Real Estate Investment Trust. They will generate rental income, transfer income, development income, etc. Are you with me? And there is InvIT also, Infrastructure Investment Trust. You can invest in that trust and that will actually develop the infrastructures, make profit and distribute it to the unit holders. So there are 2 types of trust that is called as REIT and InvIT. These are called as business trust in India. REIT, Real Estate Investment Trust, and InvIT. InvIT means Infrastructure Investment Trust. These 2 are called as business trusts. If you have units, That means if you have invested in these two trusts, then that unit you are selling and you are having a short-term capital gain, then that short-term capital gain is subjected to what rate? 111A, 15%. Are you with me? Are you with me? So very simple, friends. So you have three assets. Which all are the three assets covered under 111A? Which all are the three assets covered under 111A? Listed equity share or listed unit of equity oriented fund or listed unit of business trust. If the gain that you're having is a short-term capital gain, then the rate of tax will be at 15%. Moving on to the next one, there are few notes in relation to this. While computing this 15% short-term capital gain, you have to be careful about certain things, and let's understand which all other things that you have to be careful. So listen, as a C being, resident individual or HUF can claim unexhausted basic exemption limit. Can you read this again? As a C being, resident individual or HUF can claim unexhausted basic exemption limit. Can you tell me what is this unexhausted basic exemption limit? So I'll give you an example to understand what exactly is this unexhausted basic exemption limit. Are you all listening? Are you all listening? Say for example, friends, say I am an individual, opted out from 115 BAC. Opted out from 115 BAC means I've opted for the old slab. Okay. So, and I am having some PGBP income of rupees 1 lakh. And I'm having short-term capital gain taxable under section 111A, that is say 5 lakh. I'm having short-term capital gain taxable under 111A. How much is that? 5 lakh. So can you help me? How much is my total income? How much is my total income? How much is my total income? 6 lakhs is my total income. While computing tax liability, you have to split this into two. Number one, PGBP income, that will fall to the slab. This will be subjected to the slab rates. And how much is my basic exemption limit? Basic exemption limit is 2,50,000, but my income is only 1 lakh. So there is something balance in the basic exemption limit. And how much is the balance in the basic exemption limit? 1,50,000. This is called as unexhausted basic exemption limit. This is called as what? Unexhausted basic exemption limit. Are you all with me? Now, not yet over, friends. There is one more thing. See, you have short-term capital gain, which is taxable under section 111A. How much is that short-term capital gain taxable under 111A? It was 5 lakh. Now, with this 5 lakh, first of all, you need to check whether you have some unexhausted basic exemption limit. The answer is yes. If you are a resident individual or resident HUF, then alone you can claim this unexhausted basic exemption limit as a deduction from the short-term capital gain. Only resident individuals and resident HUFs alone can claim this adjustment. If you are a non-resident, you cannot do this. That unexhausted basic exemption limit is gone. Are you with me? Are you with me? It's not your right, it's a given benefit. What do you mean by not a right? For certain persons with certain income tax department have given this right. And the certain incomes are incomes under capital gains, not with any other incomes. Say for example, you have some casual income, taxable at 30%. Can you adjust unexhausted basic exemption limit? No. If it is given, then you can claim it. That's what I said. It's not your right, it's a given benefit. Are you with me? So that 1,50,000 I can adjust. And can you tell me how much will be my net income? 3,50,000 will be subjected to 15% rate of tax. And can you tell me how much is 15% of 3,50,000? 52,500, and there will be 4% cess. And how much is 4% cess? 2,100. So 2,100. Adding these two, how much will be my total income? 54,600 will be my total tax liability. Are you all with me? So adjusting unexhausted basic exemption limit means if you have some other income and that income is less than the basic exemption limit, the balance of that basic exemption limit is said to be what? Unexhausted basic exemption limit. I hope it is clear for you. Are you all with me? Is that point clear for you? Great. Yeah. So moving on with the next adjustment. Can you read the next adjustment? From short-term capital gain taxable under 111A, you cannot claim any Chapter 6A deduction. You cannot claim any Chapter 6A deduction from short-term capital gain taxable under 111A. It is restricted. Are you all here? And what is the final note? You can claim rebate under 87A if your total income is less than or equal to 5 lakh. If your total income is less than or equal to 5 lakh, you can claim rebate under 87A. There is no restriction for the rebate under 87A. But right now, there is a thing speculating in the market. Like they are in the latest income tax return, they are not providing this relief. They are not providing this relief. And there is some kind of tweets and all is happening. It's not officially confirmed whether it is a glitch or whether it is a part of the act. Because act, they are not saying any restriction. The restriction is only for long-term capital gain. Under 112A, you cannot claim this rebate. But 111A does not have any such restriction in Income Tax Act. But in the latest return, they are not providing this relief. That is not our concern. For our examination purpose, from 111A income, you can definitely adjust the rebate under 87A because whatever restriction provided in the act only will be the restriction. The rest we can take according to our wish. Are you with me? It's totally unfair that is happening right now. It's totally, that I can clearly say, it's totally unfair because they are not supposed to do things like that. If they want to restrict, they have to do it only through the act. Because this is actually a serious restriction. So if they want to restrict, they have to only supposed to do this by amending the law, by putting a specific restriction. Otherwise, it will speculate. Certain people will say deduction possible. Certain people will say not possible. Why? They can make clarity easily. Okay. Yeah. So moving on with the next one, friends. What is the second item? Flat rate taxable. Can you read the heading? Long-term capital gain under section 112A. So let's understand what exactly is this long-term capital gain. Can you read the heading? Can you read the text? Long-term capital gain over and above 1 lakh on transfer of listed equity share of a company where STT is paid at the time of purchase and transfer, or unit of equity oriented fund or unit of business trust where STT is paid at the time of transfer. So short-term capital gain under 111A, long-term capital gain under 112A, but under 112A there is a benefit. What is the benefit? Only over and above 1 lakh is subjected to 10% rate of tax under section 112A. That means if you have a gain of say 1,30,000, you need to pay 10% rate of tax only on that 30,000, not on that 1 lakh. Are you with me? If your long-term capital gain under 112A exceeds 1 lakh, only that excess portion is subjected to 10% rate of tax and the rest is not subjected to any taxes. Are you with me? Up to 1 is not subjected to taxes. It's just like a special exemption limit under 112A. Moving on. Assessee being resident individual or HUF can claim what? Unexhausted basic exemption limit. I hope you understand what is this unexhausted basic exemption limit. You don't require any other example because I've already finished an example. If you have an unexhausted basic exemption limit, you can adjust that with the long-term capital gain under 112A as well. But there is one condition for that. You tell me what is the condition? What is that condition? You have to be a resident individual or resident HUF. Then only you can adjust this. Otherwise, you cannot adjust this. Are you with me? Are you with me? Yes. Old RAME, basic exemption is 2.5 and new RAME, basic exemption is 3 lakh. Depends upon which RAME you have taken. Okay. So moving on with the next one. Here also you cannot claim any Chapter 6A deduction. From 112A long-term capital gain as well, you cannot claim any Chapter 6A deduction. It is restricted. Moving on. you cannot claim the benefit of 87A rebate over here. 87A rebate is not given. Why? Because when they announced the annual budget in 2019, there was a note saying that we are already giving you a benefit of 1 lakh as a special exemption limit under 112A. Along with that, we are not providing any benefit under 87A. That was the very idea of restricting 87A benefit from 112A. That's why my objection. You cannot restrict under 111A. You can restrict, but you have to amend the law. Simply coming and saying you will not give you, that's not fair. This is India. These kinds of things are not possible. Okay. If you want to restrict, you amend the law. Then you restrict. Or CBDT have to officially issue a clarificatory note or a circular stating that we will not give you. That also is objectable. Why? Because it is not a change in the law. Act, if it is amended, then definitely we all are bound to accept that, and we will all accept that also. Now, moving on, the next point, even if it is a long-term capital gain, you cannot claim the benefit of indexation while computing long-term capital gain of listed share, listed equity-oriented funds, listed unit of business trust. Don't come and ask for indexation. We will not give you, because we are only taxing you at 10% rate of tax. Are you with me? We are only taxing you at what rate? 10%. With that, don't claim any indexation as well. I hope that point is clear for you. 112A, 5 lakh. I can deduct 1 lakh under 112A. In this case, can we claim unexhausted basic exemption limit of 4 lakh? How do you get unexhausted basic exemption limit of 4 lakh, Ali Nivas? First of all, the basic exemption limit is only 2.5 lakhs. If you are a super senior citizen resident, then it is possible. Otherwise, not possible. Okay. Yeah. So, moving on to the next point. Let's understand what exactly on the next. On 4 lakh, you can adjust. Yes. 4 lakh is not unexhausted basic exemption limit. On 4 lakh, you can adjust. Yes, Alinivas. That's right. On 4, it is possible. That means 2.5, you can adjust with the 4. And how much will be the rest? 1.5 into 10%. That will be around 15,000 plus 4%. That will be the tax liability in this case. Yes, that's right. Oh, that was actually my mistake. Okay, I thought I didn't read that on. I read unexhausted basic exemption limit 4 lakh. Yes. Yeah. Moving on to the next one. Where were we? You cannot claim the benefit of indexation while computing the long-term capital gain under 112A. And there is one more thing under 112A. That is what we are about to discuss right now. That is the special circumstance while determining the cost of acquisition. Let's see. There is a special case while determining the cost of acquisition, and let's understand what exactly is this cost of acquisition. Please listen, friends. Please listen. Say, for example, I'll give you a case, okay? I'll give you a case. Before that, let's read the theory. Can you read the heading? Long-term capital asset under section 112A, its cost of acquisition. So, read the first box. Cost of acquisition if assets are purchased on or before 31st January 2018, you take either the actual cost of acquisition or lower of fair market value as on 31st January 2018 or full value consideration. What do you mean by this? It seems like very confusing, but there is no point of any confusion. What the Act says is, if you are purchasing any listed shares or listed units of equity oriented fund or listed unit of business trust on or before 31st January 2018. Which is the date? On or before 31st January 2018. Then while computing the cost of acquisition, there is a special formula for you. While computing the cost of acquisition, there is a special formula for you. What is the special formula? Either you take the original actual cost of acquisition or you take lower of fair market value as on 31st January 2018 or full value consideration at the time of sale. That simply means you first check the FMV as on 31st January 2018. Then you compare it with the full value consideration at the time of sale. Compare these two and pick the lower. Either this lower figure or actual cost of acquisition, whichever is higher, that will be beneficial. They are not saying higher in the Act. They are saying either actual cost of acquisition or lower of these two at your choice. That's what the interpretation is. They are not saying higher, but it should be higher because it is your cost. Are you all with me? I'll give you an example for a better clarity over this provision. Listen. Say, I purchased one share of Tata Motors, say for 1,000 rupees in 2015-16. Okay. In 15-16, I bought one share of Tata Motors for what value? 1,000 rupees. The fair market value of Tata Motors share as on 31st January 2018 was, say, it is 1,400 rupees. The fair market value of Tata Motors as on 31st January 2018 is how much? 1,500 rupees. Sorry, 1,400 rupees. Later on in 2023-24, I sold this shares for 2,000 rupees. I've sold this shares for what value? 2,000 rupees. Are you all with me? Let's understand how do you compute the cost of acquisition in this example. So listen, to compute the cost of acquisition, the first figure that you require is the full value consideration. How much is the full value consideration? 2,000. How about the cost of acquisition? While determining cost of acquisition, Tata Motors being a listed share, what you need to do is you need to check whether the date of purchase is before 31st January 2018. You tell me, when is the date of purchase? Is it before 31st January 2018? Yes, it is before 31st January 2018. So what you need to do is, you need to take the original cost first. How much is the original cost? 1,000 rupees. Let it be there. Now you need to take the lower of the fair market value as on 31st January 2018. That is 1,400. Or you need to compare it with the full value consideration 2,000. And you need to pick the lower. Which is lower? 1,400. And you need to compare these two and pick the higher. That will be 1,400. You deduct this 1,400 from 2,000 and the rest 600 rupees will be your capital gain under 112A. Are you all with me? This is how you have to compute the cost of acquisition if the shares are covered under 112A. Are you all here? Is that point clear? So whenever you are purchasing a listed share or a listed unit of equity oriented fund or a listed unit of business trust, and if the date of purchase is before 31st January 2018, then while computing the cost of acquisition, you have to make use of this particular formula. And what is the formula? Either you take the original cost of acquisition and put it over there. Then you compare the fair market value as on 31st January 2018 with the full value consideration at the time of sale, and you compare these two and pick the lower. Then that lower and the original cost of acquisition have to be compared and you have to pick the higher. Act is not saying you have to pick the higher, but obviously you can, it's an option given. Original cost or lower of these two. That's what the Act says. That's why we have made that column like that. I haven't mentioned whichever is higher. That is obvious. Are you with me? Are you with me? So this is how you have to compute the original cost of acquisition. Now let me tell you one thing. What if I purchase that share after 31st January 2018? What if I'm purchasing that particular share after 31st January 2018? If it is after 31st January 2018, then normal cost of acquisition. The original purchase price itself only I can take as the cost of acquisition. There is no speciality over there. Are you all with me? Is that particular point clear for you? Great. This is how you have to compute the cost of acquisition of assets covered under 112 Is there any reason for the PIC of the cost of acquisition? Yes, there is. Because that reason, I'll take around 15 to 20 minutes to explain. So forget about it. There is a reason. Because earlier, before 2018 annual budget, it was exempted under 1038. Then they brought in this particular taxation under 112A suddenly on February 2018 annual budget. So this is called as a grandfathering clause. So I'm not planning to explain what is grandfathering clause and wasting your time. Rather, you study it as equation, okay? Because, as you know, revision, we cannot go beyond certain limits. Yes, there is a reason, yes. Moving on to the next one, we have been completed the chart yet. Let's complete the other items in the chart. You tell me which all are the items that we have completed in the rate chart. Which all are the items that we have already completed in rate chart? Number one, we have completed short-term capital gain under 111A. Number two, we have completed long-term capital gain under 112A. Now we are about to compute the long-term capital gain, other long-term capital gain which is under 112. Let's understand which all are the other long-term capital gain under 112. There is no slab income, only in the 112A income only. Claim BEL, basic exemption limit. Yes. There is no normal income means your entire basic exemption limit is unexhausted basic exemption limit. Understood, Ragul? Full basic exemption limit is unexhausted basic exemption limit, and you can fully adjust that with the 112A or 111A item. Got it? Moving on with the next one, that is other long-term capital gain under 112. Can you read the first box out of it? Can you give me an example for a other long-term capital gain? Transfer of land, transfer of building, transfer of jewelry, transfer of drawing, transfer of painting, whatever it is. All other long-term capital gains will be covered under 112. Transfer of unlisted share, transfer of debenture, transfer of bond, whatever will be coming under 112. So, what is the rate of tax for that long-term capital gain? 20% on the normal long-term capital gain. There is no special exemption and all for that. Now, while computing this, assessee can claim, assessee being resident individual and or HUF can claim unexhausted basic exemption limit from the above income. Here also you can adjust the unexhausted basic exemption limit from the above income. Now, no deduction under Chapter 6A. While computing 112, you cannot claim any deduction under Chapter 6A as well. Indexation allowable. Rebate under 87A allowable. There is no restriction for the rebate and there is no restriction for the indexation, but there is a restriction for Chapter 6A deduction. Are you all with me? Now, how about the other short-term capital gain? That means transfer of land, transfer of building, transfer of debenture, transfer of unlisted share. If you have normal short-term capital gain, then that will be taxed as normal slab rates. It is taxed as a part of the normal slab rates, just like a normal common income. You can claim all the deductions. It directly falls to the slab, so directly you can claim the basic exemption limit. Chapter 6A deduction permissible, rebate permissible, so everything is permissible. It is considered as a normal income only. Are you with me? There is no flat rate for the other short-term capital gains, and I hope it is clear. Come again? That is unlisted. 112 is obviously listed. That is STT is paid at the time of purchase and sale. Unlisted means it is under 112. You can claim the indexation benefit. Absolutely no problem. Listed na, it will be under 112A. No indexation benefit. Understood? Great. So moving on. Aditya, don't discuss the latest budget things right now because you are writing your September and January. For that, that is not required. Okay, so don't discuss that here. If they discuss that here right now, students are learning the other one. So if I mix that along with this, then what will happen? Everybody will go wrong. So don't take the latest annual budget right now. Okay. Nandri solla unakku vaarthai illai. Ennada idu? Oh, this is a song. Okay. Ali, what is this? You are singing over there. Sir, long-term capital gain on listed share not paid STT. Not possible. Not possible, Maunika. You cannot, it's not an option to you. If you are trading through RSC, along with the purchase price, you have to mandatorily pay STT. Okay. You cannot transfer listed share without paying STT. It's not a choice. If it's a choice, nobody will pay STT. Yes or no? Why should we pay STT? People will never pay STT. It's not a choice. It is mandatory. Kodutte agano. Okay. Yes. So this is how you have to compute the capital gain. Now let me give you a question. You were saying you want tough question, right? Yesterday onwards, somewhere, some people in the online were saying tough question. Okay. Ida, the podunga. Take question number 13 in your page number 4. It's a fantastic question. You need to compute the capital gain as well as the tax liability. You need to compute everything. Read that question carefully, otherwise you will go wrong. Okay. Read that question carefully and give me the answer. Midun purchased 100 equity shares of Messrs. Good Money Company Limited on 1/4/2006 at a rate of 1000 per share in the public issue of a company by paying security transaction tax. No, at a rate of 1000 per share. That the share price is 1000. No, they cannot. That's what section 48. That's what we have learned. You cannot add STT in the cost of acquisition. You cannot adjust STT. Okay, that's what we have learned in the cost of acquisition. You cannot adjust STT. You cannot. Okay. So friends, ready with the answer? All right, so let's see. I hope you have computed the rate of tax as well, right? Okay, let's see. Yeah, I have a lot of answers in the online also. Good. So let's solve it together, friends. Yeah, so please listen. Shh. What are they saying? Mithun purchased 100 equity shares of Messrs. Good Money Company Limited on 1/4/2006 at a rate of 1,000 per share in the public issue of company by paying STT at the time of security transaction tax. The company allotted bonus in the ratio of 1:1 on 1/12/2022. He has also received dividend of 10 per share on 1/5/2023. He sold all the shares on 1/10/2023 at a rate of 4,000 per share. So, Messrs. Good Money Company Limited issued 100 shares. That was original shares, okay? 100 shares, we can say original shares, which is listed. This was acquired by Mithun in the year 2006. Then they issue bonus shares 1:1. That means 100 bonus shares. That issue was in the year 2022. Then in 2023 October he received dividend. You tell me at the time of receipt of dividend how many shares he have? 200 shares he have. So 200 shares into what is the amount of dividend that he received? 10 rupee per share. That means 2,000 rupees he have received as dividend. Are you with me? So 2,000 rupees he have received as dividend. Then he sold all the shares on 1/10/2023. So friends, whenever you get a question in exam, you first give some time to understand the question, okay? Read peacefully and understand the question. Are you with me? You should act mechanical. You shouldn't act mechanical, okay? It is like you just pick the figures and write the answer. It shouldn't be like that. Always sit, relax and read the question. Are you with me? It's very easy to say to sit and relax because during the time of examination, your stress level will be comparatively higher. But you can relax if you have prepared very well, you can control your stress. See, imagine a situation you have prepared very well. Then what will be your attitude? Your confidence will be high. You want to somehow write the exam. Are you with me? That is possible. Invest your time right now. From today onwards, today we are finishing our revision classes. So maybe tomorrow and after tomorrow you will be having some other revisions also. I don't know whether you have revisions or not. If you have or haven't, whatever it is. From today evening onwards, don't postpone it to tomorrow. Tomorrow also you will say tomorrow. Then also you will say tomorrow. Today evening itself, you start your preparation. Today evening itself, start with the direct tax. Start with the direct tax because you have that 4 days backup you have. We have touched all. I'm not saying we have completed 100%, but we have touched most of the areas we have touched. So start with the direct tax today evening itself. You will get that momentum. You will get that momentum. Try to solve as many questions you can, and that will definitely you will be able to crack taxation paper, that too with a very good marks in exam. Okay. So let's understand he sold all the shares. So original shares, we'll compute the full value consideration. 100 shares into what is the price money? 4,000 rupees, not 2,000. We've sold it for 4,000 rupees and that will be 4 lakh. How about bonus shares? Same, 100 into 4,000, that will be 4 lakh. How about dividend? 2,000 rupees, let it be there. Now, is there any direct expenses on transfer? Direct expenses, yes, there is brokerage at 1%. STT is not a direct expense. You cannot claim STT as a direct expense. You can only claim brokerage. 1% brokerage means 4,000, 4,000. 1 or 2? 1%. So how much will be the net sale consideration? 396. Now, how about cost of acquisition? Of original shares, original cost of acquisition is how much? 1,000. Or lower off. The fair market value as on 31st January 2001 is 2,000. or full value consideration, the time of sale is 4,000. You compare these two and pick the lower, that will be 2,000. And compare this 2,000 with the original cost of acquisition and pick the higher, that will be 2,000. So 2,000 will be the cost of acquisition into how many shares you have? 100 shares. Can you claim the benefit of indexation? Can you claim the benefit of indexation? No. Why no? There is no index number in the question. Huh? No, because there is long term. Yeah, long term. I didn't get it. Like, come again. Yeah, because it is long term capital gain under 112A. So the remaining long term capital gain will be 1,96,000. And here, since bonus shares, you cannot claim any cost of acquisition, and your short term capital gain will be, this will be short term and this will be long term. Why the other is short? Because you received it in 2022. You are selling it in 2023. The period of holding is less than 1 year. Are you with me? So it is short term and the other one is long term. Now can you help me? How much is the total income? You have dividend income of 2,000 as well. So how much is the total income of this person? While computing total income, you have to say 5,94,000 is your total income. 92. 196 plus 396 plus 2,000. What is the total income? 594. You can split this into 3. Which are the 3 splits? First of all, we'll take dividend. Dividend will fall to the slab. And how much is his basic exemption limit? How much is his basic exemption limit? 3 lakhs. Why 3 lakh? He wants to celebrate his 75th birthday. That means his age is 75. That means he is a senior citizen. His residency status they are not mentioning, but the assumption is he is a resident. If the residency status is not mentioning, then that person will be always a resident. So can you tell me how much will be the basic exemption limit? 3 lakh. And unexhausted basic exemption limit will be how much? 2,98,000 will be the unexhausted basic exemption limit. Let it be there. Now how much is the long-term capital gain under 112A? You know it is 1,96,000. From that you can deduct 1 lakh. Because only over and above 1 lakh is subjected to 10% rate of tax. So 96,000 is the balance. Now you have, 96,000. Now you have short-term capital gain under section 111A. How much is that? 3,96,000. Now let me ask you one question. You can adjust unexhausted basic exemption limit with both long-term and short-term. But we should have the priority from which you have to adjust it first. Short-term. Why short-term? Rate is 15. If you adjust it with the short-term, your overall tax liability will be less. Are you with me? Are you with me? This is called as beneficial construction. If the position is not clear in the exam, then you can, if the position is not clear in the act, then you can take a interpretation that is most favorable to the assessee. So what you need to do is you can adjust that unexhausted basic exemption limit of 2,98,000 with 396. Can you tell me how much will be the short-term capital gain after this? 98,000 will be the short-term capital gain. And this basic tax will be at 10% on 96. That will be 9,600. And here basic tax will be at 15% on 98,000. How much will be that? 14,700. And can you tell me how much is the total basic tax liability? Total basic tax liability will be 24 or 34? 24,300. And now you can claim the benefit of cess at 4%. Not benefit, you have to add, you have to pay extra cess. What is 4% cess? 972. And can you tell me how much is the total? 25,272 will be the total tax liability. I hope it is clear. ICA book back sums plus illustration plus RTP and past year questions enough? Yes. In case PGBP income also combine this sum, we can't claim STT in the deduction under 36. No, Ragul. If your main business is from purchase and sale of security only, you can adjust STT. Otherwise not. No STT can be claimed by full-time investors in PGBP. What are you saying? Can you do the sum in slum sale? Yes. Round off 270. Yes. Okay. This is the first part of the answer. Come again? You want to show? You want me to show? That dividend will fall to the slab. Dividend? Shh. What's the treatment of dividend in income tax? What's the treatment of dividend? IFRS will fall to the normal slab rate. So that fall to the normal slab and your basic exemption limit is 3 lakh. Then unexhausted basic exemption will be 298. That you have to adjust it with the 396 and you will be having the remaining. Got it? Rebate on short-term capital gain. How much is the total income? 598. You can't claim rebate here. Rupees 4,700 can be claimed as a rebate. No, you can't claim rebate because the total income is 594. Okay. Cost of acquisition is always purchase consideration even before share purchase before 2008. I didn't get it. What is this, Unni? Past exam question paper. How many year question papers we have to solve? At minimum 5 years. Minimum. I'm not saying that is minimum 5 years. That's what I can say. Minimum 5 past exam question. Minimum 5 RTPs and the latest RTP, MTP. That will give you an idea. Ready? 50% standard deduction you can claim. You're talking about compensation or interest. Okay. Take that compulsory acquisition under that IFRS. Whether it is on enhanced or whether it is on the original compensation, whatever interest, IFRS only. Come again? No. It's in the year of receipt only. Whenever you receive that, in the year of receipt, that is under IFRS. Come again? How much you are getting as interest, irrespective of its year. In the year of receipt, you have to pay it as taxes. You have to compute the taxes, okay? How much interest there is no standard rate for the interest. That only the court decides. It's not decided under IT Act. Whatever the interest they awarded, that interest will become your total income. Purinjada? For that, what is the rate of interest from which period you will get interest and all is the discretion of the court. Yes. If it is BAC, then you can claim the rebate because it is 7 lakh in BAC. Yes. Can we get your notes? I think that is already shared. Okay. Ganesh, that is already shared in the group. All right. So moving on, friends, we were discussing about where were we? Yeah, we were discussing 112A. Now we will discuss another concept called as slum sale. Shh. Keep quiet and listen. Shh. We will discuss another concept which is called as what? Slum sale. See, imagine a situation. Say, this is a business, okay? Say, this is a business. And you are the assets and some of them are the liabilities, okay? You are the assets and some of you are the liabilities also. I am selling this entire business for a lump sum value. Say there are around 300 plus assets altogether, both in online, offline, everything. Say imagine there are around 300 plus assets and we are selling all the entire business for a lump sum consideration. We are selling everything for a lump sum consideration. Say if there are 300 plus assets, how do you compute capital gain? Yes, the lump sum consideration you are getting. I am selling this entire business for a lump sum consideration. That means all the 300 assets are getting transferred in a go, in a single shot, for a lump sum consideration. So there is actually a big headache. You have to first of all proportionate that consideration among 300 assets. And you have to compute 300 computations. Yes or no? Are you all listening? Say there is a business and the business have around 300 assets. And that business is getting transferred for a lump sum amount without assigning values to the individual assets and liabilities. And that lump sum amount, you have to proportionate and you have to compute 300 computations because there is 300 transfer of assets happened. Are you with me? Isn't it a headache? It's a heavy headache, a huge headache. So what departments say, in such scenario, don't treat it as a single transfer. Rather, you consider that entire business as a single asset and compute it, the capital gain in a go. Rather than splitting and rather than doing the proportion and all, you consider that entire business as a single asset. Then you compute capital gain for a entire business in a go rather than computing 300 transfers. Are you with me? This concept is said to be what? Slump sale. Treating that entire unit as a single asset and computing the capital gain. That process, that concept is said to be what? Slump sale, which is under section 50B of capital gain. So let's understand what exactly is that 50B slump sale. So can you read the heading? Capital gain in respect of slump sale. So what is slump sale? Can you read the first definition, the meaning? Slump sale means the transfer of one or more undertaking for a lump sum consideration without assigning values to the individual assets and liabilities in such sales. Very simple. Slump sale means you are transferring one or more units in a go. Okay? Without assigning values to the individual assets and liabilities. And that concept, that sale is said to be what, friends? Slump sale. Are you with me? Are you with me? Now, listen, how do you compute capital gain? Let's see. I've told you that you treat that entire business as a single asset and compute the capital gain. That's what I've told you. Yes or no? You treat that entire business as a single asset and you compute the capital gain. Now, there is a problem. Whether that asset is a long-term asset or short-term asset, normally it depends upon the period of holding. Yes or no? Whether an asset is a long-term capital asset or short-term capital asset, normally it depends upon the period of holding. Period of holding means the period in between the date of purchase and date of sale. But here what department say, nature of gain shall be, if undertaking is held for more than 36 months, then long-term capital gain. Otherwise, short-term capital gain. If that entire undertaking is held for more than 36 months, then entire undertaking held means what? You started the business for more than 36 months. The business is running for more than 36 months. Then that particular business will be treated as a long-term capital asset and the gain that is about to come will be long-term capital gain. If you are running that business for less than 36 months or equal to 36 months, then it will be a short-term capital asset and the gain that we are about to compute will be a short-term capital gain. Is that point clear? Now, we are about to discuss how do you compute capital gain in slump sale. So listen friends, what is the format for computing capital gain? What is the format for computing capital gain? First you require full value consideration. Then from that you can deduct direct expenses. Then you will get net sale consideration. From that you can deduct cost of acquisition or cost of improvement, whatever it is. Thereafter, you will get the capital gains. Are you with me? When it comes to slump sale, what is full value consideration? Very simple. Department say either fair market value 1 or fair market value 2, whichever is higher. You have to compute the fair market value 1 or fair market value 2, whichever is higher shall be your full value consideration. What is fair market value 1? That simply means the fair market value of net assets transferred. Net assets transferred. What do you mean by net assets transferred? In a slum sale, I'll be transferring some assets to a third party. Yes or no? Yes or no? For a lump sum consideration, the fair market value of the assets that I'm transferring is said to be what? FMV 1. Now the question is, what is FMV 2? The fair market value of assets I received as consideration. That simply means when I'm transferring you, the person who purchases you should pay me some consideration. Say he's giving me money consideration, then that money will be FMV2. He's giving money plus some gold, then fair market value of the gold and the value of money will be the consideration. He's giving me some money plus gold plus some land, then the market value of land plus money plus gold will be the FMV2. Are you with me? Are you with me? So whichever is higher have to be the full value consideration. So the point is very simple. Whenever there is a slum sale, the full value consideration have to be either the fair market value of assets transferred or the fair market value of the consideration received, whichever is higher. Are you with me? Whenever there is a slum sale happening, either the fair market value of the net assets transferred or the fair market value of the consideration that I've received, whichever is higher have to be the full value consideration for the purpose of computing slum sale under section 50B. Is that point clear for you? Is that point clear? Moving on. What is direct expenses? Normal brokerage or commission. Your direct expenses will be the normal brokerage or commission. There is nothing special. You take the normal brokerage or commission as the direct expenses. There is nothing special. How about net sale consideration? Full value consideration minus direct expenses will be the net sale consideration. How about the cost of acquisition? Department say for the cost, you compute the net worth of the transferred business in prescribed manner. In prescribed manner. For the cost of acquisition, you do one thing. You compute the net worth of the transferred business in prescribed manner. Are you all with me? What is net worth? What do you mean by net worth? Asset minus liability is net worth. Asset minus liability is zero. Asset minus liability is zero. That's why your balance sheet is getting tallied. Okay. Asset minus outside liability will be the net worth. Or we can say share capital plus reserves is said to be the net worth. Are you with me? So for computing net worth, there are certain things that you have to be very careful about. So let's understand how to compute the net worth. So net worth means assets minus outside liability. Assets minus outside liability. Which all are the four types of assets we have? In income tax, they're saying, while computing this net worth, you have to consider four types of assets. Number one, depreciable assets. Depreciable assets of the company. What should be the value for the purpose of cost? WDV as per IT Act. That means in your balance sheet, when you're transferring some depreciable assets, for the purpose of computing cost, you have to take what value? Written down value. What is written down value? The value that you have computed after claiming the depreciation is said to be the written down value. Now you tell me, what's the second type of assets? Act says assets where 100% of cost already allowed as deduction. Already allowed as deduction. What do you mean by assets where 100% of the cost is already allowed as deduction? Section 35 AD specified business assets or Section 35 scientific research asset, etc., where you have already claimed 100% of the cost as a deduction. Such assets, what should be the value? Nil value. Why? Because everything you have already claimed as a deduction. Now you cannot again take any value for the purpose of computing net worth, because that net worth is your cost right now. Are you with me? Now, how about the third type of assets? It is goodwill, self-generated goodwill. Self-generated goodwill. Always take what value? Nil value. For self-generated goodwill, you are not supposed to take any value. That's what the department say. And finally, other assets. You always take the book value. Whatever the value provided in the book, you can take as the value for the purpose of other assets like debtors, stock in trade, bank balances. You take the book value, land, etc. You take the book value. Are you with me? Are you with me? So whenever you are computing the net worth, you require the total value of assets minus outside liability. While computing the total value of assets, you can split that assets into 4. Which all are the 4 types? Number 1, depreciable assets. Number 2, assets where 100% of the cost is already allowed as deduction, you take the nil value. Self-generated goodwill, you take the nil value. Other assets, you take the book value. Don't worry, everything is there in the column, okay? Everything is there. Total value of assets minus outside liability. Okay, I've simply written it as a chart, that's it. Everything is there in the revision note. Now listen. In relation to the outside liability, always take the book value. Always take the book value. Purchased goodwill, other asset, book value. Purchased goodwill, you consider it as the other asset and take the book value. So, or outside liability, you take the book value. Then this sum, this net will be your net worth without indexation. You cannot claim the benefit of indexation while computing slum sale under section 50B. Are you with me? Are you with me? You cannot claim the benefit of indexation while computing the slum sale because it is not subject to any indexation. Now the next one, while computing the value of assets, you have to ignore the effect of revaluation. What do you mean by ignore the effect of revaluation? Imagine I have a land. What? Just before my slum sale, I revalued the value of land. I revalued my land and I've inflated the value. So land is not a depreciable asset. So it will come under the other asset category for the purpose of computing net worth. Yes or no? If I inflated the value, can you take that entire inflated value as your asset value? If you take that, your net worth will be higher. Your cost will be higher. Capital gain will be lesser. Are you with me? So department says that if you have revalued anything, you need to remove the effect of revaluation. Always ignore revaluations. We will not accept any of the revaluations at the time of computing the net worth. Are you with me? Are you with me? So whenever there is any revaluation in the value of the asset, you have to ignore the effect of revaluation. I hope you got my point. Now we will discuss the theory one by one. This is the concept. First of all, we will discuss the theory one by one. So can you read the cost of acquisition? What will be the cost of acquisition? Net worth of the undertaking or division, as the case may be, shall be deemed to be the cost of acquisition. Indexation benefit is not available even if it is a long-term capital gain. Now, how do you compute the capital gain? How to compute full value consideration? It is the fair market value. FMV1 or FMV2, whichever is higher shall be the full value consideration. What is FMV1? Fair market value of the capital asset transferred by way of slum sale. Now, what is FMV2? The fair market value of the consideration received or accruing as a result of slum sale, whichever is higher. Now, what is direct expenses? As usual, that is minus that is normal brokerage or commission. Don't read it as usual minus normal brokerage divided by commission. Okay, it's not like that. Normal brokerage or commission. Then what is cost of acquisition? Net worth computed in prescribed manner. That is the aggregate value of the total assets with the undertaking or division minus value of outside liability for such undertaking or division as appearing in the books of accounts. However, any change in the value of asset on account of revaluation of the asset shall not considered for this purpose. You have to remove the effect of revaluation. Now, how do you value the aggregate value of assets? In the case of depreciable assets, WDV as per the provisions of Income Tax Act 1961. And capital asset in respect of 100% reduction is claimed, value shall be nil. Self-generated goodwill of a business or a profession, nil. For all other assets, book value. For outside liability, book value. This actually slum sale is very easy. Rather than computing this 300 or 400 computation, you consider everything as one single asset and compute in a shot. That's what is called as slum sale. Is that point clear for you? If this BAC, okay. I didn't get this notes. You have to get it. Yeah, it is there. Then can we get, okay, are referring to charts on the screen if you get this, okay. While filing ITR return share purchase date before ITR and all, okay, 2008 option is there. Short-term capital can have any reference sources, don't know. Don't ask me any practical things right now, okay. It is a revision session, not for practical things. Yes. So do one thing. I'll give you a question. I want all of you to solve this question. That's a fantastic question. Okay. Question number 12. It's your institute study material question, but it's a superb question. We don't even have a past exam question in this level because it's a fantastic question. Q12. It's in slum sale. We'll complete this question and I'll give you a break, Surya. Don't worry. We'll complete this and I'll give you a break. Okay. Okay, Sudha. We want indexation, cost of acquisition. No, no, no. You don't. You are not supposed to take indexation, Ragul. You can't take indexation. Okay. So shall we do it together? Let's solve it together, and after that, let's go for a break, okay? So listen, friends. How do you identify whether, how do you identify whether a transaction they are referring to slum sale or normal capital gain? How do you identify? See, no individual value of any asset is considered in the transfer deed. This is the clue. Are you all listening? And in this question, they are clearly mentioning that it's a slum sale. Okay, even if it is not there, if there is a transfer of a unit or an undertaking without assigning values to individual assets and liability, then that particular transfer will be considered as a slum sale always. Are you with me? So how do you compute capital gain in slum sale? What is the first thing that you require? You tell me. What is the first thing that you require? You require full value consideration first. What is full value consideration? Full value consideration is either FMV1 or FMV2, whichever is higher. What is FMV1? Fair market value of net assets transferred. That is given in the question. How much is FMV1? 30 lakhs. How much is FMV2? That is the market value of the consideration received. Here the consideration is only money. Yes or no? Yes or no? And the money consideration received by the person is 25 lakh. And which one you have to take? The higher one. That will be 30 lakhs. Now, is there any direct expenses on transfer? Are they talking about any direct expenses? Where were we? Direct expenses. Yes. Tell me what is the direct expenses on transfer? 28,000. So how much will be the net sale consideration? Can you help me? 29 lakhs, 72,000 will be the net sale consideration. How about the cost of acquisition? That you have to compute the net worth. For the cost of acquisition, first of all, you have to compute total value of assets. Total value of assets minus outside liability. First of all, let's value the total value of assets. Which all are the assets we have? Number one, building. What should be the value of building? Building is actually a depreciable asset. Yes or no? But in this question, are they giving depreciable WDV value separately? No. They are not providing WDV value separately. So what to do? You then assume that this balance sheet value is the WDV value, but there is one note is there. Revaluation reserve is created by revising upward the value of building. That simply means what? This building value of unit 1, 12 lakh, it is after revaluation of 3 lakh. Are you with me? Are you with me? Because they are mentioning that the revaluation reserve is created by revising upward the value of building. So the building's value in the balance sheet is 12. That is after the revaluation. Are you with me? So what to do? Remove that. So 12 minus 3, that will be 9 lakh only. So you should take only 12 minus 3 lakh. The rest will be 9 lakh only have to be taken as the value of building. Which is the second asset? Plant and machinery. We don't have a separate value, so we are taking that balance sheet value itself as the WDV value. Then there is debtors. It is always the book value 1 lakh. Then other assets, there is a problem. Under that there is a note. What is that? Under other assets of unit 1 include patent acquired on 1st July 2021 for 50,000 on which no depreciation has been charged. So patent is actually a depreciable asset. You should have to claim depreciation. In this question, they are saying that on patent, depreciation is not yet charged. So it is not the WDV value. So you need to make it WDV value. Are you with me? Because patent is a depreciable asset and the depreciation is at 25% under intangible asset category. I think yesterday we have discussed that. Do you remember? So what you need to do is we need to take a computation for patent. So patent. When is the date of purchase for patent? It is purchased on 1/7/2021. And what is the purchase value? 50,000. So 21-22 depreciation at 25% will be how much? At 25% will be 12,500. And how much will be the closing WDV? 37,500. Now, not yet over. You have to compute the depreciation for 22-23 as well, because the slum sale happened in 1st April 23. That is 23-24 only slum sale happened. So there are 2 years, and you have to remove depreciation for the 2 years as well. Are you with me? So can you tell me how much is 22-23's depreciation? 25% on 37,500. 9,375 you have to deduct. And how much will be the closing WDV? 28,125 will be the value of patent. So you have to take 28,125. Now, there are other assets also. Excluding patent, how much is the other assets? 1,50,000 minus 50,000. So excluding patent, the value will be 1 lakh. Now, can you tell me how much is the total value of asset? Total value of asset? 14 lakh. 28,125. How about liability? Which all are the liabilities? Creditors you have. Creditors is an outside liability. 1,50,000 into what percentage? 25%. And how much will be the value? 37,500. So the value will be 37,500. How about bank loan? How much is the total bank loan? 2 lakh. Into 70%. 1,40,000. So how much is the total value of liability? 1,77,500. Now can you net it off and tell me how much will be the cost of acquisition? 12,50,625 will be the cost of acquisition, and you cannot claim the benefit of indexation. So 29,72,000 is the net sale consideration. 12,50,000 is the cost of acquisition, and how much will be the long-term capital gain? 17,21,375 will be the long-term capital gain. I hope it is clear. This is the first part of the answer. Click a picture or take a screenshot of whatever you want. And this is the second part of the answer. I hope that is clear for you. Now, let's go for a break, okay? Let's go for a break, go relax and come back. Yeah, that I'll give you, Jayasuriya, don't worry. Surya, you're planning to leave now? So, saying thank you early? Yeah, nice to hear that, Surya. Yes. So go relax and come back, friends.